I want to bring in Brian Jacobsen, the Chief Portfolio Strategist at Wells Fargo Funds Management. And Brian, do we hear you right that you think the Fed could actually start raising rates as early as July?
Yeah, sure. Why not? It could be any. There's a wide variety of opinions. We'll just throw another one out there. Sure, it'll be an intermediate rate hike, right? No, I think that actually there could be a strong argument for saying that they could raise rates in July. There's no reason why they can't. Even though there isn't a press conference at that point, it doesn't mean that they don't necessarily, that they're not going to do anything. So I think Janet Yellen is in a position where she's just going to look at the data. The data, to me, suggests that we're going to see a pickup in economic activity, that we just had this winter freeze and now we're going through the spring thaw. And if there's enough data to suggest that economic conditions are returning to normal, they might start normalizing policy come July. June might be a little too early. And actually, I think tomorrow's meeting is going to be really interesting because it's the first time that they're going to try to give us some idea about when they might start raising rates. How are they going to communicate that? Are they going to say, we expect in a short period of time that we're going to raise rates? Is it at the next meeting? So tomorrow's meeting could be really interesting.
Hey, Brian, in terms of the timing of when this happens, whether it's June, July, September, as an equity investor or someone who's looking at equity strategy and probably more long term, how much does it really matter if it's June or September? I mean, we're obsessing over this stuff. If you're a bond trader, it probably matters. From your perspective, how important is it really?
Yeah, on the equity side, I don't think that it matters all that much. Really what matters as opposed to when is the why and the how of the rate hikes. Why are they raising rates? They're doing it because they think that the economy is healthy enough that it can take it, that they want to start normalizing monetary policy. It's just the right thing to do for a variety of reasons. They're not doing it because they think inflation's getting out of control, right? So the why, as far as rate hikes, I think is very positive. It could be a positive signal for the markets. But then more importantly is the how. How are they going to raise rates? Are they going to come out with a notional rate hike of 12.5 basis points with that window that they're setting? Is it going to be a full 25 basis points? What are they going to do with overnight reverse repos? But that's all stuff that I think more affects the fixed income market than the equity markets, because the link between monetary policy and equity markets, at least when the Fed starts raising rates, is a very weak one. It can actually be a very bullish signal for stocks.
Hey, Brian, do you see deflation in the global economy right now?
I see deflation and inflation, and when you average it all together, it comes up with a little bit of inflation. There's some areas where you see declining prices. There's other areas where you see increasing prices. But broadly speaking, with the aggregates, I think that going forward, we're going to just see very tepid inflation. I think in Europe, they are actually turning the corner from deflationary forces originating from bad sources, that is a contracting financial system, to more inflationary forces from an expanding financial system. In the United States, I think that we have a situation where inflation is going to stay very moderate. I'm not sure when we're going to get back to the Fed's target. I don't think that I tend to be of the opinion that it's going to be a tough road back to normal, a very long and winding road, perhaps back to normal.
Well, I was just going to say, why would you want to buy stocks now? They're not on sale. If you're talking about inflation at maybe 2%, and you do have deflation in Germany, you got bond yields that are negative, you got bond payments that are being stopped because the rate is negative. Yeah. Why would you buy a stock now? Why don't you wait for it to go on sale? You don't want to buy when things are great. You want to buy when things are terrible.
Well, because things can get better. And I think that even though things are pretty good in the United States, it's not like they're uniformly good. Look at the energy sector. The energy sector has been battered down. Granted, it's up from, the lows that it saw back in the November period and the such. But I think that still things are a little bit on sale in the energy sector. Within any given sector, I think that there are areas where there are bargains, and there's areas where it's a bit more effervescent, so to speak. But I think that really most of the opportunities, from my perspective, are outside of the United States. I don't think that the United States is a bad place to be putting money to work, but I just think that there's better bargains outside of the U.S., specifically in the emerging markets. I think that despite the massive run-up in Chinese equities, you have a lot of Asian equity markets that have some good upside potential here.
Okay, so you're not buying China. You say don't buy China?
Well, no, I do like China. It's just China has run up a lot faster than other Asian markets, and I think that perhaps a lot of the real easy money has already been made in China. But still, look for some convergence between the A shares and the H shares in the Chinese market. That could be a good arbitrage play for institutional investors here.
And what are the other Asian markets that you think are more attractive in terms of valuation?
I like India, even though India last year did very well. I think that the India story is still intact and that the markets are improving. Their valuations are a lot more reasonable there than they are, say, in other parts of the emerging markets. But even if you look at Korea, now arguably Korea is a developed market, not necessarily an emerging market. I think that Korea represents some very good value, especially as if you look at the technology sector.
Right.
Even Japan. Japan, I have
Brian,
some...
Okay, Brian, hang on.
Brian, I'm just trying to understand something. If indeed the Federal Reserve does raise rates and the dollar continues to strengthen, it doesn't matter what these foreign markets do. When you translate those gains back into U.S. dollars, you're still going to end up having less. I don't understand. Why would you be buying now markets like this? What about going to Brazil where they got, protests in the streets and possible impeachment? If you're looking for bargains, why wouldn't you look in Brazil?
Sure, yeah, look for where there's blood in the streets, right? Isn't that kind of the old maxim from, was it Sir John Templeton who always said that, you try to invest at the point of maximum pain, where there's a lot of angst. And so Brazil might be a place to do that, actually. It's just, I think that some of the areas, if you think about the dollar strength doesn't necessarily have to be a bad thing for U.S.-based investors. You can, if you want, you can hedge some of that exposure. But a lot of what the Fed is doing is already, I think, priced into the foreign exchange market. Granted, it could create some volatility if the Fed decides to hike rates in June as opposed to July or September, but I don't think that it's necessarily going to create an abrupt and permanent change in the value of the dollar. So a lot of the dollar strength is maybe behind us. Perhaps the story for the balance of the year is a little bit of dollar weakness from this point forward.
All right, Brian, we're going to leave it there. Thank you so much. Brian Jacobsen, the Chief Portfolio Strategist at Wells Fargo Funds Management.